Welcome to The Explainer. Okay, if you're getting ready for that life insurance exam, you know just how much stuff there is to remember. So in the next few minutes, we're going to boil it all down to the absolute must-know essentials on premiums, benefits, and all the rules that hold it together. Let's get you prepped for test day.
So we've organized this into 5 key parts. First, we'll look at what a premium is actually made of. Then we'll cover the different ways you can pay for it. After that, it's all about the good stuff, the benefits. And then, who gets the money? The beneficiaries. And finally, we'll wrap up with the tricky stuff you have to know, like taxes and special rules. This is your game plan for the exam.
All right, Section 1, what is actually in a premium? If you want to nail your exam, you've got to know exactly what goes into that final price tag. So let's pull back the curtain on the 3 main ingredients.
Okay, lean in for this one, because this is a classic exam question. Every single life insurance premium, no matter the policy, is built on just 3 fundamental components. Let's get these locked in.
And here they are: mortality, interest, and expense. The easiest way to think about it is like a simple formula. You start with the mortality cost. That's the pure risk. Then, and this is the key part, you subtract the interest the company expects to make investing your money. That's right, their investment income actually lowers your premium. And finally, they add their expense factor, also called the loading charge, to keep the lights on. So it's risk minus earnings plus expenses. That's the formula.
So those 3 factors give us the starting price. But then the underwriters step in and make it personal. They look at everything about you: your age, your health, what you do for a living, even what you do for fun. A 30-year-old who works a desk job is going to have a totally different premium than a 55-year-old who skydives and smokes. This is where the general price becomes your price.
Okay, Section 2. Now we know what's in the premium, but let's talk about how you pay it. The way a policy is funded can look really different, and you will absolutely see questions on these payment models.
This table right here is your ultimate study guide for premium types. A level premium is exactly what it sounds like. It's flat, it never changes. With modified, you get a low introductory rate for a few years, but then there's one big jump in price. Graded is kind of similar, but instead of one big jump, the premium goes up in smaller steps every year before it finally levels off. And a single premium? Well, that's the easiest one. Pay for it all at once, up front. And here's that level premium in the real world. John's payment is $105 a month, and it's locked in forever. Now, his actual risk of dying goes up every single year, right? But his payment doesn't. And that's because he was technically overpaying in the early years to build up a reserve. That predictability is the whole point.
Moving on to Section 3. We've handled the money going in. Now let's talk about the money coming out, the benefits. You know, a lot of people think life insurance is only useful when you're gone, but that's a huge misconception, and it's a big topic for the exam. Let's look at how you can tap into this value while you're still alive.
This is a massive concept for your exam: living benefits. It means you can actually get cash from your policy before you die. You could, for instance, borrow against your cash value. Or if you get a terminal diagnosis, an accelerated benefit rider lets you get a chunk of the death benefit early to help with expenses. You can also straight up sell your policy, and there are 2 ways to do that.
Okay, this is a classic exam trap: via tackle versus life settlement. They both involve selling your policy to someone else, but there's one crystal clear difference you have to know. A via tackle settlement is only for someone who is terminally ill. A life settlement is for someone who is not terminally ill. Simple as that. It all comes down to the health of the person insured. Don't mix those 2 up.
Section 4. So we know about the benefits, but who actually gets them? This is where beneficiaries and payout options come in. This section is all about making sure the money gets to the right people in the right way at the right time.
This one comes down to a single idea: control. Think of a revocable beneficiary like writing a name in pencil. The policy owner can just erase it and write in a new one whenever they want. But an irrevocable beneficiary, that's like writing the name in permanent ink. They have what's called a vested interest, which basically means the policy owner can't make big changes, like taking out a loan, without getting their written permission first.
So what happens if one of your beneficiaries dies before you do? Well, that's where these 2 terms come in. With per stirpes, think by the bloodline, that person's share goes down the family tree to their kids. But with per capita, think by the head, that person's share gets divided up among the other beneficiaries who are still alive. The money stays with the survivors. Getting a giant check isn't the only way to receive the money. Beneficiaries have options, and you need to know what they are. The default is, of course, a lump sum. But they can also leave the money with the insurer and just get the interest only. They can have it paid out over a fixed period, say 10 years, or in fixed amounts, like $5,000 a month until it runs out. There's also life income, which they can't outlive. And for a couple, joint and survivor pays out until the last person passes away. Now here's the exam tip. The beneficiary usually gets to choose, but the policy owner can lock in one of these options ahead of time.
All right, we're in the home stretch. Section 5, taxes and all those special rules. Honestly, this is the stuff that can make or break your exam score. So let's make sure you don't get tripped up on the details. Let's just get this one out of the way right now. It's a super common question. For a personal life insurance policy, are your premiums tax deductible? The answer is almost always a simple no. Don't fall for any trick questions around that. This slide is absolute gold for your test. The single most important rule to remember is that the lump sum death benefit is received income tax-free. That's huge. Where taxes can show up is on any growth. So if you take the payout in installments, the interest part is taxable. Your cash value grows tax-deferred, which is great. You only pay taxes if you cash out the policy for more than you paid in. And policy loans? Not taxed. Accelerated benefits for a terminal illness? Also tax-free. You see the pattern here? The core benefit is safe, but the government wants a piece of any extra earnings.
Now, this is a rule for a pretty specific and tragic situation, but it shows up on exams. What if the insured and their main beneficiary die at the same time, like in a car accident? The Uniform Simultaneous Death Act steps in and creates a legal assumption. It says we'll assume the beneficiary died first. And why does it do that? It's to make sure the money goes directly to the contingent or secondary beneficiary instead of getting tied up in the first beneficiary's estate.
The spendthrift clause is basically a protection plan. Let's say a policy owner is worried that their beneficiary might blow through a huge lump sum payment all at once. They can add this clause. It protects the money from that beneficiary's creditors and makes the insurance company pay it out over time in installments. It's a way to make sure the money lasts.
And there you have it, a super fast review of the core concepts. Look, the key to passing this exam isn't just about memorizing definitions. It's about seeing how all these pieces fit together. So think about this for a second. Which one of the tax rules we just covered do you think most people get wrong? When you can answer that, you know you're ready. Now go crush that exam. Good luck.